All right, everybody, welcome back to another episode of the Evernest Real Estate Investor Podcast. I am one of your hosts, Spencer Sutton, and I've got my two sidekicks with me. They're back. The gang is all back together. Matthew, welcome back to the show, man.
Yeah, I saw total downloads were really low over the last few episodes, so I jumped in to hopefully save this thing.
I think Matthew just sits around in the morning and thinks about witty comebacks to your podcast intro. So he's got a list. That
I don't have to
down cross.
Listen, I don't have to sit around and think of it. They come too easy with Spencer.
He just tees it up.
And you. Look, I gave y'all your time in the sun, so now I'm back to take this podcast back over.
And you have new surroundings. Like we're in a different spot. This is a new look for us. So talk a little bit about that, Matthew.
Yeah, we just
then I'll introduce Gray later.
Yeah, who? I've never heard of him. Don't know who you're talking about. No, we're in a brand new corporate office here in Birmingham. We moved the corporate team over from the little house that kind of everybody knows us from, and we are in an office building. We didn't move too far though. I did double the length of my commute to work. Now I was driving a half mile. Now I'm driving a whole mile, and I haven't figured out the most efficient.
That adds up.
We're going to have to talk to Stan, our new CFO, about increasing my income so that I can afford to drive here, or maybe getting an electric car. And we're driving a whole mile in, and I'm trying to figure out what the most efficient way to get here is. And I think I've figured it out because it's right next to my favorite lunch restaurant. So now I can walk to it on a daily basis and get lunch like I did today.
Yeah, I've walked there twice already. And yeah, I'm 10 miles away from the office. And yesterday or the day before, I looked at my phone before I went home. A 41-minute drive. I was like, boy, this is an opportunity to learn, to listen to podcasts. So, Gray, welcome to the show, man.
I'm about 2,000 miles away from y'all, so I'm not going to be commuting over there to the new digs.
Gray and I actually just spent a little time together, and we'll probably do a podcast kind of unpacking it, but we just spent a little time together at the SFR IMN East down in Miami. So he and I were down there this week. And so kind of excited about this whole industry. And despite the fact that interest rates are rising, people are still very bullish on the industry. I mean, I think there's a lot of good things happening. And so love to talk about that. We'll probably do that in an upcoming podcast, I would imagine.
Yeah, it'd be good to talk through. I think that's on a lot of people's minds, and kind of interesting to talk about just where the economy is and where interest rates are heading. Those are a lot of questions we get from investors. So we'll probably do another podcast where we can kind of dig in what we're hearing. We don't have a crystal ball. Nobody can predict the future, but kind of give you all the insights to what we're hearing in the industry.
All right. Well, let's dive into what we're going to talk about today. And I was thinking about this subject because Matthew, this is kind of the way you and I got in the business back in the day was, and I know that you've said this many times on this podcast, and we've got a few other podcasts, but you had a lot of time and no money, and your partners had a lot of money and no time. And really same thing for me, right? So I was the one who was going to go out there and do the grunt work, find the deals, make the offers, go to closings. And I just really needed some money to close these deals. And I actually needed cash so we could close fast, but we're going to talk about that today. We're going to talk about how investors can use private sources to fund their projects.
Yeah, totally agree. This is great. Even if you have money, just having access to funds obviously helps as you're out there actively buying. And so really excited to talk about private money borrowing and lending today. So we're going to talk about it from both aspects. Like if you want to be a lender, we're going to talk about it from that. And we're also going to talk about where we found ourselves in our 20s and early 30s was doing a lot of borrowing from private lenders.
Yeah, real estate's a very capital intensive business. So you might make good money and save up, but there's going to be a point where you come across good deals and you got all your money deployed. It's not liquid. And so it's good to have other kind of creative strategies. I'm excited to kind of talk through some of these, but that's just the reality of the game. Is people joke about, before investing in real estate, you might have had a bunch of cash laying around, but it's all locked up in these buildings. So real estate investors are much more cash poor than you would think that they are.
That's why they like to talk about how many, like the amount of deals they've done, or hey,
that's the only thing to brag about. Yeah,
that's right. That's right. It's not cash.
I used to joke I was real estate rich and cash poor.
And that's a lot of the reality. Look, you're building equity in these things. And me and my wife have kind of talked through these. It can feel like paper money sometimes. You don't see it in the bank account, but it's, that's kind of what you're building for in the long term. It's both the cash flow, which is good, and just depending on the market you're in. If you're buying properties, rehabbing them, that takes a lot of cash. Yeah, that's right. Sometimes it's on the short term, you kind of recycle some of that, but we'll kind of talk through some strategies if you're running up against that.
So when you say talk to your wife about it, do you mean like trying to sell her on it? Like why this is a good idea, a good strategy?
Yeah. I mean, I think there's some of that, because I think that if you didn't kind of grow up in real estate or, do as much kind of learning and reading and investing that I do, it can feel weird to have this big kind of cash outlay when you're putting a down payment and you've got $50,000 or $60,000 worth of renovation. You see your bank account dwindle down, and I know, hey, on the refinance, you're gonna be able to pull out some money, or the equity is going to be there. And these are kind of the good reasons for it. So not as much. I mean, a little bit of selling in there. You gotta. There's a lot of different ways to invest.
You have to paint the vision, Gray. You have to paint the vision, right?
You got to sell the story.
That's right. So. All right. So let's talk about, why is this a great deal? Like, why should investors consider private money, like going and finding private money?
Well, if anybody's borrowed money from a bank, so you've gotten a mortgage or you've borrowed to buy a business or whatever, the bank there's a lot of paperwork that needs to be filled out, and there's a loan committee, and there's all sorts of checks and balances and appraisals, and it's just a lot of red tape. And so the way we think about private money is there's just less red tape around, because it really has to do more with the deal than the borrower. When you go to a bank, it's really all about the borrower, right? Like the asset is kind of second to the bank until you get up to bigger money deals. But the asset is second, and it's still pledged, but there's also typically like a personal guarantee. There's all sorts of, again, checks and balances at a bank to make sure that you're going to pay them back. And they're having to essentially be accountable to auditors that are like regulators that are coming in and looking at their loans, and they have to make sure that all their checks are, all the boxes are checked. And when you think about a private lender, there's no restrictions on that, and they can just loan you money, and they may be loaning it to you based on your reputation. And I've borrowed a lot of money from private people, not necessarily to buy real estate, but to do stuff with Evernest based on reputation. Or they may be buying into you or into the deal and understanding that, if you screw it up, that they're still able to come get that deal. So we'll probably talk a little bit more about that. Gray, any thoughts on that or any other ideas around why it's good?
So he hit on it. Red tape. If you ever got their mortgage, I looked at my last email chain. I mean, it's like 100 emails back and forth where they say, hey, we need this document. Hey, it's in the wrong format. You got to do this. And so there's just kind of that complexity to it. Banks are going to need appraisal. So if they're lending on a house, they're going to need to check the value of the house to make sure that they're not lending $100,000 on a property that's worth $25,000. And so I think speed, especially if you can, borrow the full amount, you could close in as little as 7 to 10 days. So that gives you an advantage over somebody else who might have a 30-day close. Typically banks right now, we're seeing as fast as you can probably get done is 25 days up to 45 days. Your offer is going to be more attractive. So you got the ability to win more deals. You can take it down, take it down a lot faster. I think it's kind of the biggest thing around private money. So that's a reason you would need it. There's other reasons where either all your money's tied up or you can't get conventional lending. So one of the things they look at is debt to income ratio. And depending on how long you've been doing this, depending on your lender type, they might look at it and say, hey, you got too much debt out there. Now we know that this thing's going to cash flow because we did a good job underwriting it. However, certain, depending on their comfortability with lending to real estate investors, if they're not experienced in it and understand it, Some lenders it will take 2 years of your tax returns of showing rental income before they start to count it. And so on paper, your debt to income can look like you've got way too much debt to be able to afford, as long as you're underwriting these deals. So that would be another source. If you're lending from a private lender, this is a lot of times not going to show up in your credit report. So that's just kind of a limitation that you can run into. So either not having cash, or it's debt to income, and it allows you to move faster and kind of solve the debt to income issue you might run into.
I noticed that for me, like when I first started doing it, the speed to be able to close that deal was a huge factor in closing more deals, right? So all of my offers were, we'll buy this house as soon as we get clean title, which can be as in little, we can get the clean title probably in as little as 3 or 4 days. And so if I was able to say, hey, here's my cash offer. Now all my offers were deeply discounted. So, but saying how quickly I could close and it would be an all cash deal with no contingencies made a huge difference to the sellers when we were buying at deep discount. So I thought speed was huge for us.
And I'd like to look at it from the lender's perspective too, right? Like how should you look at it if you're going to loan money? Because you think about it through the lens of, I want to invest in real estate. This is a different way to kind of invest in real estate. And I know a lot of successful people that have gotten into investing through, call it private money or some sort of hard money lending. And I kind of brushed over it talking about asset and reputation, but I think it probably bears some digging into. If I'm the lender, there's 2 ways I can look at this. I can look at it based on the reputation of the person that's borrowing it. And I know that person and I know them to be a good person. And I know they're going to do everything they can to pay me back, because I've known this person for years. And so, friends and family, that's a great way to use their money. Now, the last thing you want to do as a borrower, jumping over to the borrower side, is borrow money from somebody that's a friend or family and then not pay them back. So make sure before you do that you're clear on a plan you have a plan A, a plan B, and a plan C to get them their money back. But the other thing, and this is something we actually looked at about a year ago, is we actually looked at starting a hard money lending business. And the whole idea was, we will lend on anything we're willing to own up to what we're willing to have in it. And now you can put some like formulas around that, right? You can have formula around ARV or have it around, something, however many dollars it is to renovate the house. But at the end of the day, as a lender, you don't want to have any more in it than you're willing to have in it if you have to take that back. And I know somebody that was very successful on the commercial side that would lend money just like this, and they'd either get paid back or they'd end up owning something they were wanting to own anyways. And that was kind of the lens through which they looked at it. I win both ways. And as a lender, you kind of want to win both ways, right? Like if something good happens, you get a good return for your money. If something bad happens, you're willing to own that asset. And so it's a great way to get into real estate without having to, actually own the real estate. You're just going to own the real estate that you end up taking back. And frankly, if you get in and lend on this on a consistent basis, then you are going to take things back. And that's the good thing about real estate is there is something to take back.
Right.
You're loaning on something that's a hard asset.
That kind of brings up a question, Matthew, that I have is a lot of the things I did. Now, I did it with some partners, so we had an operating agreement. But when you're talking about somebody that has a good reputation, how official do you want to make it if you're lending money? Right. So how official do you want to make that? I mean, because I've seen a lot of deals done with just a handshake. Like, hey, this is what we're going to do. We're going to set up this LLC or whatever, and we're going to split the money, or I promise to pay you back a certain percentage. Like, talk about it from that perspective.
One of the guys that I really like to listen to is actually in the real estate business. He started a real estate brokerage called Keller Williams. His name's Gary Keller. And he actually talks about this. And he says, an agreement shouldn't be called an agreement. It should be called a disagreement. And we should basically, the only reason we're going to need this is if for some reason we disagree. And so it shouldn't be any conflict to write a disagreement that basically outlines exactly what the terms are, exactly how things are going to get handled on the front end, because it just makes sense to do that when you're not emotional about it. There's no disagreement going on, and just create that agreement on the front end. And then once you've done it once, then you can just sign the same one over and over and over again. I think that's just a wise thing to do, even as it relates to borrowing from friends and family. I mean, I have a family member that loaned us money to kind of help Evernest get started. And I gave them a note, and they, it was all official and it was notarized. And I go to Christmas dinners and Thanksgiving dinners with this person, and I still made it official. And so I think no matter what side you're on, even if you're on the borrower side,
right,
it doesn't benefit you to not have an agreement in place, because the last thing you want to do is be paying what you think is the terms of the agreement. And then all of a sudden that person is trying to foreclose on you because they thought the terms of the agreement was different.
And it makes you look more professional. I think it protects both sides. There could be less risk as the borrower if you didn't have an agreement, but what if they come back and they said, no, we agreed on 20% interest and you've only been paying them 8%. And so the things you get an operating agreement where it kind of outlines, hey, what the terms of the deal are, when's the repayment, what are the interest rates. But a lot of times if you're borrowing from a private individual, family, friend member, they're going to be listed as like a lien on the property. So if it ever went to foreclose, you want to have all your ducks in a row where you got the agreement, both sides. And then you do the right thing. So you can talk to a closing or a title attorney about the specifics in your state about how to actually execute those. But it makes you look more professional. You're going to get a reputation of, hey, he did things right. She did things right when they were borrowing from me, which is really important if you want to scale it.
I think one more thing to add is, let's say me and Spencer have this like handshake deal, but it's hard to believe, but what if Spencer's out there doing one of those crazy workouts of his and he has a heart attack and dies? Well, I don't have any proof that Spencer and I had a handshake deal at 8%. And now his wife's inherited all this debt to Matthew Whitaker. And she's thinking, you got to pay me back today. And I'm like, no, what Spencer said was this. You see what I'm saying? I mean, there's all sorts of, even if things go right, bad things can happen that are kind of outside of, outside of the norm. And, you want to make sure that everything's kind of like down on paper so that, what's accurate is what's getting done, or what the actual agreement is getting done no matter what happens.
Yep. All right, good. Well, let's move on and talk about different.
Sorry,
types.
I talked about you dying, Spencer. Not that you would die from one of
I knocked on wood for you, Spence.
Weak workouts.
Don't worry, Allison doesn't listen to this podcast, so she won't be offended. And I'm definitely.
If she knew how much life insurance, she might be fired up about it.
That's right. I definitely hide that from her. All right, so let's talk about different types of private money sources that people typically access when they're out there looking for money or considering lending money.
I think so. If you're talking to a wealthy individual, the most common ways that we kind of hear are, hey, they've got cash on hand. They might just have done a good job saving. They've got cash sitting there. They might not personally want to do the work to get invested in the deal, but they're looking at it. Hey, what is the return I could get in another investment in the stock market? What's the risk of that? And this might be more attractive to them. You might be able to pay them a higher interest rate. So they may have cash sitting there. Another common one is with all the home price.
Let me jump in there, Greg, because I think I want to look at it through the lens of the investor too, right? Like there's a lot of wealthy people that, especially in today's market, do not trust the stock market fully, right? Like they'll trust it. They were around in 08, 09. They know that the stock market can go down, and what they want is something that is tangible. Yes, they're probably invested in the stock market, but they don't want to rely fully on that. And the great thing about what this is if I have cash and I don't want to put it in the stock market, and I don't want to go out and do the work to actually buy the real estate, if I'm willing to lend on it, it's still something I can drive by and see on a daily basis. It's very hard. I can touch it and feel it. And there is a a lot of very wealthy people that got very wealthy by being very conservative and making good decisions with their money. And that's the type of person that you're looking for, right? Like somebody's going to get almost a guaranteed, whatever percent return just by borrowing, by lending you that money.
And it's really interesting because some of these people, all they really want is above market returns. I mean, they're not looking for, a lot of them aren't looking for hard money type rates, right? They're not looking for the 12, 13, 14, 15%. They're looking for just better than market rate with, I've got a buddy who does this with a local investor. He just has an account and they've got an arrangement. He doesn't charge him points. All he does is charge him like 7 or 8% for the money that he has borrowed. And I'm like, you really could charge more, but he just doesn't. He's like, no, he's maxed out and all this other stuff. He's got plenty of equities and he's like, I'm diversifying into real estate and he likes to do it. So
I bet everybody's just begging to know what that person's name is on this.
His cell phone number will be in the show notes.
You're going to put it in the show notes, right?
That's right. We'll charge $1,000 per cell phone send out.
Yeah. I think that brings up a good point, though. It's like negotiable what the terms are. There's no kind of set standard with private lending. When you go to a bank, I got quoted the other day, 6.75% interest, 3.5 points up front, which is pretty expensive. I mean, it's probably about par for the course, but an investor might say, hey, you pay me 7% interest, no points. And if you're doing a short-term project, build in the numbers and look. I mean, the way to look at it is like there's lending costs if you don't have the capital. If you don't do the deal, you get a 0% return. And maybe you have to pay a little bit higher than what you could get from a bank, but there's all these kind of flexibility within there, depending on your experience, how good the deal is, your relationship with them, et cetera.
And really what you're talking about is in the industry, they call it cost of capital, right? Like what does it cost me to borrow this money? And that is an expense, and understanding how long you think you're going to need the money would help you understand if, it may be that 3 points and 5% interest is a higher cost of capital than or 1 point and 12% interest. It just all depends on how your best guesstimate of what's going to happen and how long you're going to need the money.
Speaking of cost of capital, I think the other kind of place that potentially a private lender could get the money would be from like a line of credit. So either they've got a business and a bank is willing to give them a line of credit, or a home equity line of credit. These are pretty common. We've had a ton of home price appreciation. Banks will lend either on, they might have their personal residence where they've got a ton of equity in there and they want to, put that money to work. They might have some other rental properties and they might just be maxed out from a time standpoint, but they have these access to lines of credit. And so when we talk about building equity, these are opportunities to use that equity in the future. And so some HELOCs, like they might have promotional rate. Like I just got one 2% interest for the first 12 months. So if a private lender looks at that and say, hey, if I can lend that out at 6 or 7%, I'm making a net effective 5% on my money, and it's better than it just sitting in the account. So that might be a way that they could arbitrage some of the interest rates. Those are typically it really kind of ranges, 4 to 8%, depending on how big the line of credit is, your relationship with the banks. But that could be another access of capital that's not purely cash, but kind of functions as is.
Another one would be, and this is not like going to wealthy friends and family, but actually going to the person that's selling you the house and using their equity. Let's say somebody owns the house outright, using their equity, right? So let's say, a house, I can go to that person and buy that house for $150,000, and we kind of agree on that. And we know it needs $20,000 in work. Well, I may have the $20,000 via a line of credit or via cash in the bank. I don't have the $150,000. I can either go borrow that from a friend and family, or I can actually, if that person owns the house outright, I can essentially get them to sell it to me and give them a mortgage back. And so then I owe them that $150,000, and they know I'm going to invest this $20,000 in it. So they're pretty secure, because worst case, they can take back the house and have a $170,000 house for $150,000. But and so I can use that seller's equity to essentially if to fix up the house, and then I can either refinance the seller off of it if I was going to rent it, or of course I can sell the house then on the retail market, pay the seller back their $150,000. And then of course I make whatever the difference is. And I've only invested 20 and might make another 20 or another 30 on top of that.
Yeah. I know
the mentality behind that. Like, why would a seller finance a deal?
Well, it may be a house that they can't sell. You may actually know the seller and they may be willing to do you a favor. You may incentivize the seller, right? Like truthfully, all the other offers they're getting are 140, but you're willing to pay 150 if they're willing to seller finance. So, in other words, you're saying I'm willing to do all this work. I'm willing to invest this money in it, and I'm willing to essentially share the profits with you. And so just incentivizing a seller, we've done that a lot, not with real estate, but with businesses, and incentivizing somebody to essentially be the bank for us. And that's really easy. I mean, that is almost the easiest deal you could do, because you don't even have, all you still simply have is two parties, and you can get your closing attorney to draft a mortgage and a note that they'll file, and it'll be no different than if a bank was doing it. And it would be, filed against as a lien against the property. I mean, at the heart of it, this is a very simple transaction.
Yeah.
I think this happens.
You can even go ahead, Spence.
Well, I was just going to say, I think this happens more than we think. Right. So I remember Matthew, somebody we know here in town, they actually bought a portfolio of rental houses, and it was just seller financed. I mean, this person had owned them for a long, long time. Some of them needed work or whatever, but they were mostly all rented. And they made a offer, and he seller financed the whole entire package. And
yeah, I
mean, they already had the income coming in. He knew he could take them back if he needed to, if the person defaulted. So it happens a lot.
It does. And I think to hit back on what Matthew talked about, it's like your price, my terms and your price. And so you may be able to pay them a little bit more, and you can structure this any number of ways. Just like we were saying, you can negotiate the points paid up front and the interest rate. I mean, I've heard of people paying no deposit, and they'll pay a deposit in 6 months. They get a tenant in there. It starts cash flowing. You save up the money from the cash flow and you pay that as a deposit to the owner. You can structure these as like a balloon payment where you can run it out 2 years. You're going to refinance, do some work. I mean, it could even be longer. And I think typically this might be somebody who's got the property paid off. They've owned it for a long time. It's worth a lot more than they might be charging under rent. So even if you just paid them interest only, they might get a guaranteed amount when the pitch to them is, hey, you don't have to deal with maintenance. I'm going to pay this to you every single month. You don't have to worry about leasing it. Like, I'll take on all those burdens. And in 2 years, I'll pay you the money back. And you can even have a servicer, like a loan servicer. You give it to them and service the loan for them. And so it's a very official kind of, steady way. So that's it. A very creative one. It can allow you to scale. That's not going to report on your credit as well. And so that's a very popular one if you can get in front of sellers and negotiate that with them.
I wouldn't just think of it as like short-term money all the time either, right? Like, I think this is possibly a way you could build a rental portfolio. If you had a private lender that you could access their capital at 8%, maybe you're just getting started and they could get a steady 8% return on their dollars, especially again, in today's market. Who knows what the stock market's going to do? But if I had, if I knew for the next 5 years or the next 10 years, I could get an 8% return on my dollar invested, that seems like a pretty conservative, that's backed by real estate, a pretty conservative investment. And obviously gets more and more conservative as somebody pays it down and it amortizes.
I met somebody this week at the conference, and he's 25. He bought 120 portfolio and 120 door single family rental portfolio, all seller financed. And he didn't have the capital to do that, but he got in front of the seller. He was out there hustling, and he found somebody who had owned the real estate for a very long time and still wanted to make the money, didn't want to sell, didn't want to pay the capital gains on the money and kind of defer that later on. And so look, it still happened. I think he bought it in the last 6 or 8 months. So these kind of things are out there, and not even just one off. Like, you might find a portfolio owner who's owned it for 20 or 30 years and it's all paid off. And this could be a really win-win scenario for both of them.
One of the interesting things too about when somebody does that, you think about it from the seller's perspective, the seller always remembers when they were in that position.
Mm-hmm.
And so there is some nostalgia, and we're going to talk a little bit about the story, but there's some nostalgia in those of us that have been doing it a while. I mean, Gray introduced me to this guy and he said, "Hey, he's you 20 years ago." And all of a sudden I had an immediate connection to him. But there is some nostalgia with the kind of the story of getting started. And, we all remember there was somebody that gave us a shot, and, we want to be the person that gives the right person a shot. And so I think that if you're kind of young and looking to get started and you're a hustler, then I think it's probably something exciting that these people are willing to do. It's kind of a win-win, right? It helps them tell the story, live vicariously through the new person, but also not pay capital gains tax. So there's all sorts of incentives on the seller side for something like this to happen.
Yeah, it doesn't even have to be a full portfolio at first. I mean, an experienced investor might say, "Hey, what I'm going to do is I'm going to give you a shot at these few rental properties out of the portfolio. I'm going to see how you do. I'm going to mentor you. I'm going to kind of move you along, see how you're doing before I entrust all of this to you." So yeah. So where do these people, if you're an investor and you want to build a rental portfolio, where do you find these people, and how do you persuade them to partner with you?
I don't know. The more I talk about it, I may not give this answer because it makes me kind of excited to go out and do it myself, actually. Where would I look for these people? Well, look, I mean, you can, tax records are probably the easiest thing to do, right? You can see how long people have owned these portfolios in tax records, and reaching out to them and cold calling them and trying to connect with them would be my thing. Gray, you have any thoughts?
No, yeah. Finding seller finance portfolios tax records is going to be the best thing. I think also telling everybody what you do. A lot of times I've seen an investor maybe list one property, someone out here last week, and asking, "Hey, do they have anything else for sale?" They might be selling these off one by one, and you might be able to offer them something. But you can get lists. Title companies provide those lists. There's a lot of kind of data sources out there that will allow you to kind of search for that. And look, not everybody wants that. You've got to understand what the seller wants and see if it kind of lines up. And so not everybody who's got a paid off property is going to want to do this. But yeah, I think PropStream is a good place where you can pull, hey, how much is the property roughly worth? How much do they owe on it? And start, reaching out direct mail, kind of direct contacting would probably be the best place to start.
I also think that if you're a hustler, if you're out there hustling and you're in a market, you can also develop relationships with local property managers, right? And get to know them. They are going to have access to a lot of investors, probably people they've done business with for a long, long time. Now, I'm not saying call us, but definitely you could meet some investors, some long-term investors through local property management groups.
Yep. And I think if you're in kind of zoom out, so that's seller finance, we talked about cash, talked about HELOC. And the other one might be retirement accounts. If you can get a loan, you can invest through there. So how would people start to find these people? I mean, at the end of the day, real estate is all about your network. It's about who you know, and it's about your reputation, and it's about hustle. I heard some guy.
You're learning well. Quote. You're learning well, young Jedi.
But it's true. I mean, look, it takes hustle to go out there and find the seller with 120 units, and you've got to have a good reputation of doing what you say you're going to do, and it's in your network. And so I think telling everybody what you do, hey, I'm investing in real estate. Do you know anybody who's looking to sell properties? Or, hey, I'm investing in real estate. I need somebody to partner with on this really good deal I have. Do you know somebody? I think you'd be more surprised if you started asking people how many people have capital available and are looking for, a return, kind of like we talked about.
Well, there's always people, no matter if they're buying as well, that are willing to partner on deals. Yep. And so if you need the money and you say, if Spencer had the money and I went to him and I'd say, hey, if I find a deal and I'm willing to do all the work, would you fund it? And then we do some sort of split. And if Spencer has enough money, there's not a person in the world that's in this business that wouldn't do that. Right. That's right. I mean, it has to be the right deal. It has to be the right person. But like you said, Gray, I mean, if you have a great reputation, people are going to be willing to give you that money because they know they can't find all the deals. And so having access to more deals just makes a lot of sense.
So how do you, like we talked about this, like how do you communicate that, this is like when you find these people, how do you convince them to trust you to do these deals?
Well, you convince them by executing, right? Like getting them maybe on terms that aren't as favorable to you as the buyer and more favorable to the lender. And as you start to develop a track record, then you can go out and tell the story to other people. Hey, I've been borrowing from another person and paying this. I've done 10 deals and paid them this much money. But now that I'm kind of like working through this and I'm kind of got some processes and some things figured out, I'd love to start paying less or going back to the same person. Right. And as you build a reputation with that person, you can start to change the change the deal. Yeah. From deal to deal. Right. It makes sense too, because anytime you're a lender, you're thinking like, what is my risk? If there are a lot of unknowns, then my risk increases. So then my interest rate ought to increase along with that risk. As you reduce the risk for that person, and you do that through doing what you say you're going to do, paying them off, communicating with them, making sure things are going well. As you reduce the risk, then it ought to cost you less and less as you build a better reputation. And so what I would say is go out and get started, even at a deal from a lending standpoint that you may not think is as fair to you, because the more you do it, the better it's going to get.
I would say, depending on your relationship, like it's always helpful to like lead with a really good deal. And I think the best people who do this and who've been most successful will create almost like a slide deck or like a pitch deck of, hey, this is my experience. So if you don't have any experience, list out other things that you feel like are relevant. If you have done deals, say, hey, I bought this. These are the numbers on the deal. We bought it for this. It appraised at this. It cash flows this, or we bought it and we sold it for this. And so you can start to build a kind of like, a deal book that shows your experience and communicates why they should invest, and communicate the merits of the deal. Talk about the market, talk about your knowledge of the market, what you're getting it for, what the potentials are, what the multiple exit strategies are. So communicate why it's a good deal for them to invest. And at the end of it, you're telling your story about, hey, this is my experience. This is what we're going to do. And then acknowledging the risks of the deal. So I think it's good to get out in front of like, hey, these are the things I like about it. These are the things that could go wrong. This would be our plan to mitigate it. And if you can kind of put this in front of an investor, I think this gives them a lot more something tangible to look at. And maybe you meet with them and go over it, but giving them something to look at will get them excited about it. And so I think even like a 4 to 5 page kind of PowerPoint that you put together that communicates the structure of the deal, that will put you a lot better than, hey, I've got a deal you want to invest.
How about an Amazon 6-pager? Would that work?
There you go. That might be helpful too. I think one of the things I've learned over the years is don't go to somebody that you're trying to borrow money from and be fuzzy on the ask. What I have found is these people have money. They don't want to think, they don't want to be creative and come up with a deal structure. What they want is you to say, this is the deal. Is it a yes or a no? Essentially, maybe more tactfully than that, but that's essentially what they want, right? Like, here's the deal. Here is the terms of the deal. Is this something you'd be interested in doing? Yes or no? Because one of the things that I think that's a mistake I made really early is I would go to people and say, hey, you're better at this. You've done more of these. You tell me what you think's fair. And some people, especially people with money that are busy, just don't have the bandwidth to figure out the deal and, don't want to invest the time, energy, and effort. They just want a yes or no question, and then they'll look at it and make the decision yes or no. So, that's why I like the idea of the slide deck. And you could probably even get a capital commitment from somebody that up to a certain amount of dollars, just based on having a plan and being very clear on what the ask is.
Yeah. I thought like structuring it in their favor on these first. If this is your first time, like you don't have any leverage. necessarily. I mean, hey, it's a good deal, but you want to show them good faith. Hey, I'm going to structure this in your favor. You might give up some of the equity. You might give a higher interest rate. The more experience you get, you can start to charge less or negotiate those where it's maybe a little bit more in your favor. But at the end of the day, you want these things to be fair. And I like that idea of these first couple. You want to give them a very good incentive to invest in this.
And I also like what you said, Gray, about like acknowledge the risk, because I was reading this Keith Cunningham book, The Road Less Stupid. And one of the things he says is we're very good at communicating like the possibilities. Like we're always the optimists. We're not very good at communicating the risk and what could go wrong. So if you acknowledge that to a very serious investor or somebody who has money, has access to capital, I believe they'll appreciate that. Like, hey, what could go wrong? What's the worst case scenario? Here's how we're going to like mitigate that risk. But if that does happen, here's what we're planning to do. So I think that's some really good advice.
And truthfully, they know. They just want to know that you know. Mm-hmm. Like you're not hiding anything from somebody that's been in this business a while, it's pretty clear what the risks are. But the fact that you know the risk, I think, increases their trust, which increases their likelihood they're going to do it.
All right. Last, kind of as we're wrapping this up, like what kind of advice can we give someone listening who might partner with, like they're going to be lending the money? What would you give them if somebody approaches them? Maybe they don't have a lot of experience in real estate, right? So they haven't done a lot of deals. Maybe they hadn't done any deals, but they get approached by somebody looking to borrow money to invest. What kind of advice could you give them?
Well, for somebody like us who's been in the business, we could lend based on the asset, right? Like we could somebody could come to me, I could go drive by the house and I can know how much money I'd want to be in that house, right, and be comfortable lending that money. What I would say is if you've never been in the real estate business and you don't know the answer, then you need to lend on reputation first and then asset second. Yeah, you need to make sure you secure the asset, but making sure that you're lending on the name of the person and the reputation of the person first. Maybe over time, as you're in this business and you understand values and you understand how the business works, you can scale your lending business to the lending on assets. But I don't think that makes a lot of sense really early. If I'm just getting into this, I need to go to somebody that has character, that I know is going to pay me back, and maybe even lend to somebody that has a track record. So the inverse is also true, right? If I'm lending money, maybe I'm giving somebody a better deal to begin with, because truthfully, I want to lend to the better investors, and the better investors that have a track record will command different interest rates. And so, just like we said, if you were getting started as a borrower, you would go and essentially give the better deal to the lender. If you're getting started as a lender, maybe going to some of these better borrowers and giving them a better deal. And these borrowers will talk, and they'll talk to other borrowers, including new borrowers. And as you grow your lending reputation, then you can start to charge certain amounts of money to people that maybe know less as you take on more risk. That's kind of the lens through which I would look at it.
I would like trust but verify. So you may not have any real estate experience, but if they're like the question's going through, like, hey, is this actually a good deal? What have houses sold for around there? You can go on Zillow and you get houses sold in a certain area, like trusting but verifying what they're saying about all of this. I think also thinking through, like, how long do I want this money locked up? And what are the chances it could go on longer? So if you need this money, if you're going to buy a personal house in 6 months, but you're like, hey, I want to get a return on this, that might be too much risk right there, because if interest rates change and they can't refinance and you have to hold this out longer. I think thinking through those things, and then just, reputation, what's the borrower's ability to repay this? Like, do they have, I don't think it's bad to ask, do they have good credit? Have they talked to lenders about refinancing out if it's short term? And so this is kind of more on the short term, but I think it can apply to the long term as well. So I think just thinking through, like, hey, how do I trust but verify what this person's saying, their experience, what the deal is, and then what can I live with? How much money can I afford to lose? And how much is the property worth? So I think thinking through all of those kind of like facts of the deal, just very logically would be helpful.
All right, guys, this has been great. I appreciate y'all's insight. And, I was just thinking about this as we were wrapping up, talking about people looking to get into real estate, especially people who are newer, wanting to kind of hustle and build a rental portfolio. I think one of the best ways you can get into the real estate business is if you want to come and join our team. Like, aren't we looking for people on our brokerage side, Gray? You want to talk just real quickly about that?
Yeah. We talk a lot about not quitting your day job. I think we've got a really cool opportunity for investors who are currently investing to, work in this full time. We are working with a lot of investors. I think you would get a ton of experience just working with other clients, learning what they're doing well, learning what works, learning about the market. And, as we grow our team, we've got boots on the ground. You can really get to know, hey, what are we actually renting properties for? What does it look like to, what does the maintenance look like on these things? So I think that, I think we've got an opportunity to do a lot of deals and you can make money, which is, we talk about being capital intensive, but like the education component is extremely important. And so if you are interested in real estate investing, you don't have to have your license. Would love for you to reach out. You can email me at ghall@evernest.co if you're interested in that. Would love to talk through. We're hiring in a ton of different markets. We're continuing to grow our footprint. And so we're looking for people who are interested, because we think if you're interested in investing yourself, you're going to be a better client or investor agent for your client. You're going to be personally motivated to learn and to get better. So that's we're super excited about. We've got a ton of really cool opportunities. So if you're interested, we'd love for you to reach out and we can set up a call and talk through what that would look like.
All right. Thanks for that. So if you haven't already, leave us a review. We'd love to hear from you. And we'll be back next week with another episode of the Evernest Real Estate Investor Podcast.